Alright, so a lot of people want to figure out ways to generate consistent income with limited risks. So in my previous video, I covered the strategy of selling cash secured puts to generate income. And now in this video, I'm going to cover how to sell covered calls to generate income. So without further ado, let's get straight into the video. So now before I take you guys through selling options, I'm going to quickly recap what happens when you buy a call option. So when you buy a call option, you get the right but not the obligation to buy a stock at the strike price. You are risking the premium you pay for the option and you're betting on the stock to go up. You can sell the option anytime before the expiry date for a profit or a loss. So when you have a long position on calls, you're betting on the stock going up. You're risking only the option premium that you paid. And just like I covered before, you can sell to close anytime before the expiration. Now with covered calls, you are selling the option and you are taking the other side of the contract. You're selling to open the contract. So this means you are the market maker here and you are most likely to benefit from this exchange. And you are most likely to profit. So when you sell the option, you collect the premium when you sell it, and you don't have to give any of it back unless you buy to close the option before your expiry date. On average, 90% of options expire worthless, so your odds are really in your favor here to profit from this exchange. And a key detail here is that you can only sell a covered call if you own 100 shares of the underlying stock. You could sell a call option without owning 100 shares of the underlying stock, but it would be called a naked call. And with a naked call, you have potential for unlimited losses, so I'm going to cover this on another day. But one thing to remember here with covered calls is that at expiry, if the stock price is above your strike price, you're going to be forced to sell your 100 shares at the strike price. The covered call strategy involves selling a call option at a higher price than the current price of the stock, and you collect the premium on that contract. The most common scenario where you would use this strategy is when you have a long to medium term holding in your portfolio and you may not think that it has much upside in the short term, or maybe you think it might go down a little bit in the short term. So you sell a covered call above the price it currently trades at, hoping for the option to expire worthless and collect the entire premium and still own the stock. The gains here are going to be much more substantial than a dividend and can be done any number of times over a period of time for a different period. You can always close the contract before expiry for a profit or let the option expire out of the money and pocket the entire premium. If the option is at the money at expiry and the contract is still open, you'll be forced to sell the stock at the strike price. Now I'm going to show you guys how all this works with an illustration. Let's say we have a stock trading at $170 right now. I'm showing you options that expire in 2 weeks. The option premiums are shown here on the left as of today. You own 100 shares of the stock currently worth $17,000 total. You think there's a chance that the stock may go down in the short term and you want to generate some income by selling a covered call. You sell the covered call for $175, which is $5 above the current price of the stock. You are selling the call at $2 per share, meaning you get $200 for the contract. Now let's see what happens in a week's time. The stock has gone down from $170 to $165, and your option premium has decayed from $2 to 50 cents. As you are short the option, you have already gained $150 from this. You can now close the option right now and secure your profit of $150, or you can wait till expiry for the contract to expire worthless and collect the entire amount of $200. This option will rise in value as the stock goes higher and drop in value as the stock stays exactly where it is, like flat, or the stock goes down. As long as the stock stays below $170, you can close the option for a profit. Say the stock goes up at the expiry date to $180, then you will lose money if you close the contract. So you can opt to sell the stock at the strike price of $175. So since you have collected the premium of $200, it is the equivalent of selling the stock at $177. When the option expires, and if you still hold it and the stock is above $175, you will be assigned, meaning you sell your shares, your 100 shares at $175. Now to summarize all of this, selling covered calls is an income generating strategy where you can pretty much make money for free while you hold a stock which you don't mind selling at a higher price. The risks involved in this are that you may miss out on big gains if the stock breaks out while you still hold the short option contract. There's always the risk of the stock falling, of course, but the option will have no negative effect on this because you pocket the premium. Now, you should only do this for stocks which you have done fundamental analysis and technical analysis on. If you don't want to do that, you do not want to do this on stocks that may break out suddenly after you sell a call. The best for this strategy would be stocks that are stuck in a range-bound stocks, where the option can decay really fast. You can also do this before any news event for the stock where you accept short-term downside to hedge, but there may be big premiums to collect it because on an event like this, there's a lot of volatility and the stock may move a lot. So this strategy played right is going to allow you guys to make a lot of money and keep your portfolios. But just quick note, make sure to not sell a covered call when a stock is about to break out. So a quick example here is Nvidia. People who sold covered calls in Nvidia when it was around $200 missed out on 100% to the upside or a $250 move. So just keep that in mind when you're playing this. Now that's going to be it for this video. If you enjoyed it or learned something new in this video, please make sure to drop it a like and subscribe to the channel. And I'll see you guys in the next one.